Welcome to Investors Insights. I'm Greg Powell, President and CEO of Five Plan Partners, and I'm joined by my distinguished colleagues, Bobby Norman, who's Managing Director, and Trey Booth, who is our Chief Investment Officer. We all serve on the Portfolio Strategies team, and we've just finished a great meeting and want to share with you information that relates to your portfolio and your financial blueprints. Our topic today is we have never seen. Now, why did we choose that topic? Today in our discussions and debates, one of our research groups that we work with, Strategas, made a great comment in the research, and I'll read it verbatim. We have never seen a U.S. recession with corporate profit growth staying positive year over year. Think about that. We are getting ready to conclude 2025 and go into the 2026 year. I think that's a statement that you need to know about, and we're going to debate it. We're going to discuss it in this vlog today. So, Bobby, I'm going to ask to start with you because you talked about profit margins, and it ties into that comment about we have never seen.
Yeah, so as we close out 2025 and start strategizing for 2026, there are a few themes that we're looking at that will impact the markets going into next year. And so first, as you can see in this chart, it has been mighty impressive to see estimated 12-month S&P 500 operating margins continue to soar higher. Like Greg mentioned, we've never seen a recession with this type of earnings growth, and that's great. Corporate America is on solid footing that not only impacts the near term, but offers a strong runway for the markets to continue to perform well in 2026. And so in looking at earnings, another theme that we're following closely is the broadening out of the market. We have been mentioning that the markets in the past 3 years or so have been driven by a small handful of stocks, mostly large cap technology stocks. The great news is that we're starting to see signs that the market is finally starting to broaden out going into 2026. As you can see in this next chart, comparing the earnings per share of the Magnificent Seven stocks and the other 493 stocks that make up the S&P 500, that earnings of the 493 stocks are finally expected to catch up with and converge with the Mag 7 stocks. This might be one of the top investment stories of 2026 and something that we're looking at closely as we build our investment strategies going forward in 2026.
Yeah, I thought our meeting had a lot of positives to it. It's always great to come out of there with that kind of data, looking from a historical standpoint. But then there's a lot of variables. And so we always are watching those variables. There's no guarantees, as we always tell people. But then, Trey, one of those variables is called the Fed. And you had great information about that. So here we are. We have never seen a U.S. recession with this whole profit issue, growth in corporations. Now we need to just turn and say, but where's the Fed? Mm-hmm. So talk to us about that.
Yeah, thanks, Greg. So as we talked about on our vlog last week, the Federal Reserve had their final meeting of the year, and they announced, as we expected, a 25 basis point cut. So that gives the range for the federal funds rate currently sits at 3.5 to 3.75%. What came out of this meeting that was unique is that the Fed had several quotes that won't sound like anything to most people, but for Fed watchers, it's very important because every word is watched very closely and dissected. So they said the extent and timing of additional adjustments were debated, and we are currently within range of plausible estimates of neutral. So what does that mean? That's a long-winded and weird way of saying we're probably not going to cut next time. This is your last cut for a little bit. And that's, to us, that's positive. Something we've been watching closely is what is the follow through of the Fed bringing down short-term rates on the long-term interest rates? Because long-term rates is what borrowers borrow at. Savers save at the money markets and what's at the bank, that's short-term. But people borrow, corporations, individuals, they borrow more based on the long term. And so we really want to see what the follow through of these recent cuts. How does that flow through to the economy? How does that flow through to longer term interest rates? And it's hard to see that impact if you're constantly changing that front number. So the fact that they're willing to pause through January, that puts the March meeting really as the first what would be considered live meeting. So that gives us several months of data to kind of look at and analyze. And what we're watching for closely is where we want to see it hit the economy is the 30-year mortgage. We've been talking about the 10-year Treasury rate. That's the most important interest rate in the world.
Yes.
But where it hits individuals is, all right, so the U.S. government can borrow at this rate, the 10-year Treasury rate. What can individuals borrow? And the 30-year mortgage is the most common mortgage. And what this chart shows is the difference between those two, what's called the spread. So the U.S. government can borrow at 4%. Individuals are currently borrowing for 30 years at above 6%. So there's a 2% spread between what the 10-year Treasury and the 30-year mortgage is. We want to see that come down. This chart shows the historical average is 1.77%. So you don't need to see 10-year Treasury rates or the federal government borrowing rates come down considerably to really see a lot of improvement in what people can borrow at. So if the 10-year Treasury stays close to 4 and we just get back to historical averages, then the 30-year mortgage will go all the way down from above 6, where it currently is, all the way down to 5 3/4. For a lot of people, when you amortize that over 30 years, that's a lot of money. That's a massive impact. So while the Fed is on pause, what we're going to be watching is that flow through to the real economy. Are we going to see relief for borrowers? Because we've come as we've entered the year, the last few years since we had that spike in inflation and spike in interest rates, the market has constantly anticipated the Fed starting the year strong with 5 to 6 cuts. That's not expected right now. The market and the Fed are both expecting very few cuts next year. That's good, because if we're not heading into recession, to the point of what Bobby and Greg are pointing out, what is the Fed fighting? If they're not trying to save the economy from recession by cutting rates, why are they doing it? And so if we're in a strong economy, strong stock market, strong corporate earnings, then the Fed being on pause is a positive sign and something we really like to see. Then if they're on pause, can that what they've already done, the cuts they've already put into place, going from above 5% now to 3.5%. Let's see that flow through to the real economy, get longer term interest rates low. That's what we're watching closely, because that'll flow through to corporate America, will flow through to individuals' balance sheets for their financial blueprints. And that's really, you'll start seeing the positive momentum of lower rates and the economic growth.
Yes, you did an excellent job on that. So, and how many times to both of you do we get the phone calls or discussions in meetings? Not only what do you think the stock market's going to do, what do you think interest rates are going to be? How do you think mortgage rates are going to be? How's corporate profits looking? Today, we're answering those questions as we're looking forward to go into 2026. And so we've got a lot of positive news. We, of course, will always, as we like to say, only the paranoid survive. We will always be on alert, looking for those things that could blindside us. Economic news, trying to have vision down the road. But we thought you would be very pleased to get this information today. So, and just know that we will continue to provide information, not only one-on-one, in phone conversations, Zoom. We also, in our social media, LinkedIn, Twitter, Facebook, our podcast, YouTube. Also, Instagram is new now, and we've gotten a lot of positive response on that. So, folks, we thank you for believing in us. We cannot believe we're getting ready to end the 2025 year, which has been a great year. And we're looking into 2026 as a positive year. And we're going to keep you updated all the time. And with that said, every day we come in the doors of Five Plan Partners, every team member here is striving to see to it that our clients have a better, richer, fuller life. We want you to have a great week. We want you to end the year on a positive note, and we look forward to seeing you in 2026 as well. Thanks for believing in us. Take care.